All right, so we got the confirmation of the news we got yesterday that we've been waiting for the past couple of months, and for that matter, for about a year or so. And the market didn't quite react as probably we thought it would react. So I'm going to break down the pattern in the aftermath of the China trade phase one deal announcement, what it means for our expectations, and how it changes, if at all, the current posture that we have on the S&P 500, and what really supports that posture, all the different patterns. I'm going to point out a few patterns that really supports that posture and how long we can expect it to last. I'm also going to show one of the stocks that can be one of the big drivers in the market and the pattern it's showing for a potential trade idea of the day. So let's go ahead and get started. Today is Friday, December the 13th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see here that we got a doji today. So we got the announcement from our end yesterday, the confirmation of that announcement and making it pretty much official today, because really yesterday's headlines wasn't any different than the headlines that we had on October the 11th, as I mentioned in yesterday's Market Outlook video. But today you can see getting a doji, which means you had a pretty decent battle between the bulls and the bears today on this news. You would think that the bulls would have overwhelmed on this. We've been waiting for a trade deal to come out, at least the announcement of any kind of agreement at all to come out for a couple of months now. Well, really for a long time, but for a couple of months, the last time the quote-unquote phase one deal was announced back on October 11th. So once we get that, you notice we didn't get that rally. We got the rally yesterday in anticipation of one. We got it today, and it's a pretty decent doji pattern after as long as we bullish as we've been. And you notice the near-term line setting up for lower highs with easily higher highs on the index itself, suggests that we could get a near-term divergence. Now, the near-term divergence, the low point in between is just right here. But keep in mind that we're also still high. We're higher than this high, and we're easily lower. So that also puts into play more like this 23% retracement level just above 3,100. So it's not very far down. It's not very far down at all, actually. But it's enough that would create potentially a pink shading. It would bring the intermediate line down below 80, so that'd bring the light pink shading. And if we did touch 3,100, we'd get a yellow, or close below it, or close near it, we'd get a yellow line because we'd be below that moving average, which normally in and of itself would be a pretty bullish pattern. So it wouldn't be a bad thing for that to happen. And I expect in the near term, especially if we hold this news over the weekend, nothing changes. There is no backing out of the deal. So if that occurs, then watch for next week to be kind of an exhale, right? Because we had this big inhale, waiting and hoping and getting this trade deal, and now, again, the buy the rumor, sell the news type of phenomenon. I wouldn't be surprised if we got that here, especially considering how bullish we were in the near term, and we've been getting some choppy near-term runs here, which aren't surprising, and we're 2 months into an intermediate rally. So it's long enough to be a pretty decent-sized intermediate rally here from a timing perspective. So that doesn't mean necessarily it has to be over. I actually don't think the intermediate line is going to get below 50, but I do think it's going to drop below 80 and produce another pink, light pink shading. As you can see on different intermediate trends going back a couple of years, on different intermediate trends, you can see this one had a couple of runs of light pink shadings, one of them with a yellow line. This intermediate rally had 3 light pink shadings. This one came close, but didn't get the light pink shading, but got the yellow lines there. And over here we didn't get one, and over here we didn't get one. But you see how it's not too bad to get light pink shadings. You end up getting some bounces in the continuation of the run, and that's actually what I expect that we'll get here. In fact, you could say here that we were getting some divergences on the intermediate line, but we just kept going up into September of 2018 before the big, which ended up being much bigger decline because of the Trump tweets and the Fed policy. Remember, the Fed was raising rates here during that pullback. during that pullback there. So we have been getting clusters. We ended up with a cluster on the weekly chart. So all four lines up above 80. That's a pretty significant cluster. But again, I don't think necessarily that it's a cluster like this. Well, that one's not above 80. A cluster like this, where we were euphoric, we had been bullish for a long time. I actually think it's more a cluster like this one, like we saw in 2017. I wouldn't be surprised if we got some kind of, and this was a little bit of upward momentum still before we got some consolidation. That's the type of, I expect this type of move to come out of here, out of the type of run that we've had. If you look at the monthly chart again too, we've got a cluster on the monthly chart last time, and that, again, that same beginning of 2017 is right in this area. We had a monthly cluster going into that as well. So we're beginning. There's your light pink shadings and the yellow lines on the monthly chart, and we had the light pink shading in the yellow line on the weekly chart back here, and I don't expect that we'll get one again on this pullback, but I expect that so here's the 2016, same thing, right? We rallied up into early 2017. We didn't get light pink shading on the pullback here, and this was early 2017. So if we go to a daily chart, let's go to a weekly there, and then to a daily chart. So here's early 2017. There's the cluster. There's that consolidation that we got, and it did actually bring the intermediate line down below 50, but you can see here at the very beginning of 2017, at least, all we got was a weak bearish posture. So I expect that we'll get probably something similar to at least either something like where the intermediate line falls below 80 or something more significant. I think we need a little bit more of a run higher to get something more significant on the intermediate type pullback. Obviously, you have lots of support in this area. If you look at the Bollinger Bands, for the S&P 500, pull back to 309, 312 first, 309 is your next layer of support, and then you're looking at 300 after that. So, going back to here, 309 is going to be right in this area. So, if worst case scenario, I think that support holds, because if it doesn't, then we're down here to this 50% retracement, and that probably would bring the intermediate line down below 50, and that's not what I expect to happen. The Russell 2000 was a little bit more bearish. Its near-term line is on its way down, and that's the kind of pattern I expect that we'll see on the S&P, leading to some more weakness. We didn't quite get the cluster on the Russell 2000, but a move back down to 1600 to the old resistance after this breakout would not be surprising at all. So again, this wouldn't be trend-changing weakness in the least bit. And we can still keep going up because the markets can stay irrational longer than you can stay solvent, right? That whole idea. So divergences can last for a long time before you finally get significant weakness. There was a question about that here that I'll talk about a little bit later today from my Q&A session that I had this morning, Saturday morning, from my Q&A session where I talked about divergences. So I'll bring that up here in just a minute. One last thing I want to take a look at here on this chart, though, before I move on to a different segment here, is not the Bollinger Bands, but the Ichimoku Cloud. So again, any weakness down to 309 would dip us below the blue line, but still easily be above the cloud, and that's a buy the dip signal. Like, that's a normal, very decently sized. We had this one over here. We got close to one here. That's a buy the dip signal that you typically get when you get a dip below. When you get the light pink shading and the yellow lines. As you can see here that we have a very strong trend going right now on the S&P, and when you get above these lines I've drawn, we can have some pretty decently sized trends for a while. So again, like I said, any weakness we get, I would expect to just be short term before we continue this trend higher. It looks worse than it actually is. It looks more parabolic, I guess would be a better way of saying that, than it actually is. If you take a look at it this way, you can see it doesn't look so parabolic, right? Some of these moves that was pretty parabolic. Some of these moves look pretty parabolic, and we're not, we're not approaching any of these type of moves with the move that we've got right now. Alright, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below if you're watching this on YouTube. That notifies you when these videos are posted. Hit the thumbs up icon down below the video. That's our survey. That's how we see whether you like these videos or not. If you liked it, if you want us to do it again Monday, click the thumbs up. If you didn't really care for it, if you don't want us to do these videos, you let us know by not clicking on anything down there. While you're down there too, comment. What did you get out of it? Was there any comments or questions that you have about anything I discussed in the video? Join our website for free at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click that link. It takes you to our subscribe page. You can get some of the features that we have on our site for all of our free members. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created. If you're watching the Market Outlook on our website, you see there's a link to our Market Outlook live videos. This link right here takes you to where we manage these trade ideas I give you in these videos from day to day, all the way to their close. So I know that's a very commonly requested item. It's like, hey, if you're putting on these trades, what about, can you look at them again? Well, that's what we do every time we do these videos. And we also put on today's trade idea before the market closes. So we've actually already put on Friday's trade during Friday's Market Outlook Live. So that comes with your Plus subscription. If you're this Plus subscription plan under pricing, that comes with access to all of our classes as well as that Market Outlook Live. So that's the $99 a month plan. If that's something you're interested in there. There's our schedule for our classes, partial schedule at the beginning of the week. Click on this view more, or click on trading rooms, and you can see all of our classes and their schedules there. We also invite you to engage with us on social media. The more you click, the more you like and engage with our content, the more likely they are to promote our content to your top of your timelines. So that way you don't have to look all the time, and you'll make sure you see our stuff that we put out there. But they only show you the content you engage with, that you look at and you engage with. So we try to make it really easy. Just click that heart. It opens a new window where you can click like, or click on this thumbs up. It takes you to your Facebook page. You can like it from there as well. All right, now let's go back to the charts, and you see the weekly chart for the S&P, and we still got some rising momentum. We're above a rising 50-day moving average. We got a good bullish Heikin-Ashi candle here. So the trend is still definitely bullish in the long term, and I don't think any short-term weakness would change that. If we again go back to that early 2017 time frame, that's the consolidation that we had, and we were just a little bit more bullish than we are now when we got that. And there's that strong candle. We had some pretty sideways small candles here before the consolidation. So if we're going to get anything similar to what we saw coming out of those weekly and monthly clusters in early 17, then that again, it would not be trend changing. That didn't change the trend over here. In fact, we had a good couple of intermediate runs coming out of that, and I would expect the exact same thing to occur here on the S&P 500. Let's take a look at the 3 green arrow chart. And oops. For some reason it always comes up with NUE. There's that doji pattern again, a little bit of a weakness sign, but we do have 3 green arrows. So now let's talk about that MACD divergence. So there's a question today about, we can get these divergences on the MACD before we get these big turns to the downside. For example, back here in 18, and I've mentioned before that we started to get these convergences, a convergence here, and then we popped out with the tax reform passing and then the implementation, the new calendar year. And then things really hit the fan from a China perspective that led to broad global weakness for a couple of years. That was in that euphoric. So this is kind of a rare situation. The other example of the that was asked about today was before we got this big turn. So will any divergences here lead us towards or warn us of these types of pullbacks? Well, keep in mind, and let's go back now to the 6-month chart. Well, let's go a little bit longer. Just I want to keep it smaller so I can zoom in. But when you get this big move higher, generally the lines will, the MACD stands for moving average convergence divergence. So you tend to get a divergence to the downside and then a divergence really quickly to the upside. That happens a lot. It's not too often where, like this, we kind of got a semi-convergence here, and even that wasn't very much of one. You notice the MACD in blue, which measures the gap between the red and the green lines here, the 8 and 17-day exponential moving averages. When it goes up pretty big. But when it goes down, you notice it doesn't go down. It will peak, and then it will grind for a while, and then this finally fell. But you notice that the lines will converge before it falls. If I were to go back a little bit of time here, to this period and zoom in on it, if it will let me. Here we go. So you can see that by the time we got that divergence to the downside, the lines had been converging for a long time. After the initial surge, the initial divergence right there, and we had a few other little pops of divergence, of positive momentum, but then we converged. And so, right now I think we're getting another pop of positive momentum that can be up and down, right? These pops don't last very long. But you would expect that we'll converge towards zero. The blue line will converge below zero before we diverge to the downside. So I still think that there's still plenty of room for divergence or for convergence to occur before we get some weakness on the S&P, because these lines are still pretty wide. I mean, this measures the gap between the two lines, the green and the red lines. The fact that it's so far above zero tells you it's still pretty high, which means there's probably still some convergence left. Now it could fall. Anything can happen, right? So you can have big moves down, but for the most part, it generally gets closer to zero before it diverges through zero to the downside, and that's kind of what I would expect. That's the general trend. A lot of these were kind of event driven. There's catalyst tweets and things like that caused these. Lacking something like that, it's generally just a convergence, and you run out of buyers during that convergence, and then you diverge to the downside. It doesn't last very long before you diverge right back to the upside, and then away you go again on a new intermediate run at that point. All right, now let's take a look at the intraday chart, and you can see the nice little pop to new 4-week high point that we have here. It'll be a while before we get a new 4-week low point, at least for this to move up. Now we could drop and get a new 4-week low point, but again, that's where the 309. If I take let's go to a longer time frame. Let's go to the 90 days. You can see the 312 volume node, which doesn't look as big on the 90 days as it does here. And then there's your 309. You can't see it as well, but this is your 309 node. Those are the only two little layers of support that we have on an intraday basis above where we're at or below where we're at right now before you hit 300. Right now you'll start to get into the value area of the past 90 days. In fact, here you can see it better if I put on an hourly chart. There we go. Now you can see a little bit better. So there's the 312, there's the 309, and then it's down to 300 after that, which is where the 50% retracement level is. And I had to activate that drawing. So right into there, that's where that retracement level is, the 50%. Actually, it would be the 62% now on SPY. But that's where your layer of support will be. I don't think we'll hit that. I think we'll, at best, we'll probably hit this 312. At worst, we'll hit the 309 before we find some support. And that's where the 32% retracement is, a little bit above it. We bounce off of that. We move higher. That's the 4-week low point. The midpoint is right around the 312 layer 2, so there's going to be that layer of support there as well. If you take a look at today's volume and trading range, the trading range was a little bit above average, not as big as yesterday. Yesterday we were at 3.82, so we're down to 2.65, but you can see another level of volume at 81 million. So you put those numbers, 81 million and 2.65 in the context. There's where 2.65 is, so very low, well below 1%. And then, because 1% move is 3.17, so anything above 3.17 points, that's a 1% move that would bring this line higher. So as long as you stay below 1%, anything below 3.17 points, and the ATR itself is below that, we're pretty bullish. And the volume, you can see, it was 81 million, so that's right there. not very high. I'd be more concerned if we were at 100 plus, 100 to 150. That would be more concerning from a volume standpoint. So, like I said, I especially think, again, considering the seasonality, I especially think that next week we'll get a little bit of a breather before the Santa Claus rally typically ends the year. But if I were to seasonality this chart here, and then go to see if it shows me over the 20 years, and then do the percent. Prices percentage, and I'm on SPY and I'm on 20-year chart. Okay, so here's where we are in December. Here's December the 12th into Christmas, and so you can see that that's next week right there. That's typically been a relatively bearish week going into Christmas, and then the Santa. You don't see the rest of this for some odd reason, but generally speaking, coming out of Christmas is a bullish week, heading into the end of the year. Let's take a look at the volatility charts. The volatility chart really pulled down. So these 2 days of announcement and bounce, we pulled down to below 13, just like that. We were just flirting with 16, and now we're back below 13. So big drop. But you notice that we didn't drop down into like these kind of lower extreme level. We are in the lower level of the bullish range, right? The midpoint is this 85%. We're in the lower half of the bullish range. Below 80% is extreme. So I mean, we're pretty solidly bullish here. A little oversold in this volatility. So again, if we bounce up in volatility, I wouldn't think it'd get above 90. But we're solidly bullish either, so we can continue to easily maintain this intermediate trend that we're on. There's still no cracks of signs of weakness yet. There's a few red flags I brought up, in a video or two before, and they're still there. They don't necessarily tell us not to trade bullishly, and they are risk factors to keep an eye on, and as a result, you want to manage those risk factors according to what we teach you at Market Scholars. In fact, we talked about that a lot this week, is how to, we did it in our directional option strategies and in our technical analysis class. We talked about how to manage these additional risk factors, yet still maintaining, this bullish posture because of what the charts like we showed here today. So some risk factors again with some short-term weakness that could come up, but the trend is still strongly bullish, and so we trade according to what we see, not what we think we will see or what we think we should see. We manage the risk factors of things that might happen, but we always trade what we see. Also, too, with that Plus subscription I mentioned before, you get the archives of all of our classes. So if you want to catch what we talked about this week in those classes, you can get that too with that $99 a month subscription. But what do you think about this technical analysis summary that I just came up with? This idea that we're strongly bullish, that there's this potential for short-term weakness, but not trend-changing weakness, and we got a good trend going. Do you agree with that assessment? Do you disagree? How do you manage that? You can share that in the comment section below. But I want to hear your vote too. Click on that link. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below on why. What are you seeing that suggests either you're a lot more bullish or a lot more bearish than what we came up with here, and share that with what's driving your opinion with our community down below. All right, now if you take a look at what's driving the price action here, and we see how things move today. Look at emerging markets. They had a really good week here, up 3% overall in the week. You can see crude oil started off the week weak, and then rallied and ended up relatively strong. International stocks all benefiting from weakness in the dollar today, down 0.5%. And then you can also see small cap stocks by the end of the week lagging behind the large cap stocks. So not the most risk on move today, other than the fact that that emerging markets have done really well this week and had a good move. If you take a look at here the different foreign markets and how they rallied here. Let's see, it'd be this one. Nope, this one right here. And how they moved here today. or Friday here, you can see they, a lot of these really continue. Look at the UK on the Brexit news, or at least on the election news that has Brexit implications, and everything else. I mean, long upper shadows on some of these, but big, strong, good moves. Japan getting a cluster. I mean, look at all the dark green shadings and the green lines. I mean, that's about as bullish as you can get. The only one that's not dark green shading and green line is Italy, and it's light green shading. It's really darn close. So again, very, very broad-based rally here across all the major economies globally. That's a good sign. Again, in 2018, when the markets were bullish for most of the year in the S&P until that October high, it was the only one that had dark green shading and a green line. Everything else was dark pink shading, and it was really bearish on a lot of these stocks. So here we go. This is what it looked like on October the 3rd of 2018 when the market had peaked. You can see strong bullish posture, dark green line, dark green shading, but look at everything else. I mean, you had a few, Brazil and Russia and Japan, that had been doing well, but we had dark pink shading in India, Germany, Italy. We had light pink shading in France, UK, and South Korea. We had yellow lines. Some had red lines. You can see how some of these were already rolling over. It led to some, I mean, that was the Q4 of 18 was a bad quarter for the whole globe. So there's a little different picture here compared to what we see now with this chart, right? We are dark green and green lines all across the board, and that's a very, very good sign for risk appetite when everybody like this is participating. Now, one of the reasons we got for that is we're starting to get some weakness, or not starting, but we're getting some more weakness in the dollar. A little bit of a bounce on Friday, but not a trend-changing bounce, more of an oversold bounce. You can see we got dark pink shading and a red line on this. If I zoom out a little bit more, this was a peak on the intermediate line, dark green shading, but it was a lower high point. We are now to a lower low on this intermediate lows, right? So here's our last kind of, and even that wasn't really an intermediate low, it was more this. So we had higher intermediate lows here and the higher intermediate high. In fact, if I go back at a couple of years, you can see every time we had an intermediate low point, we had that one. We had, really, it was this one here. This one was obviously kind of a temporary one too. This is more of an intermediate low point. That is actually a market sentiment low. Both of these were market sentiment lows. And then we had this one over here, which also was a market sentiment low point. So if you look at these were all gradually higher lows all the way up until here. But now you can see the intermediate line, market sentiment line, still below 50. And now we're getting lower intermediate lows. So that's a little bit of a concern here. This was obviously a kind of a peak, a lower high point, and now we're getting lower lows. I think there's a good opportunity for us to move down towards this 94 level on the dollar index, and that's really bullish, especially for, again, all across the globe and not just in the US for risk appetite. If you take a look at TLT, which has bounced up, you notice it came down towards this 38% retracement level. It bounced back up towards the Ichimoku cloud, and it's still staying. It's, we had a little bit of a bearish trend here, but it's still staying below that. So there's some resistance on top of long-term bonds. So if bond prices continue to fall, bond yields will continue to rally, and that's obviously a bullish sign. You can see the 10-year yield, not necessarily a long yield, but a 10-year yield still has room to go up towards 2%. If you take a look at its candle, the actual candle pulled down at the end of the day on Friday, but it's got some room to continue to fill in this gap up towards the 200-day moving average. Again, going out a little bit longer term for some perspective on this PPO. Like we got this little divergence here. I don't think we'll get a divergent low point. As you can tell, these were kind of a triple bottoming here at these levels. We didn't get a divergence on this either, and we made a pretty decent run at the end of 16 coming off the Trump election. I don't know if we'll get that big of a run here because we don't have that same news coming out. But you can see again the potential for, even at -9, that's still pretty low, pretty strong negative trend, and what can come out of that, a pretty decent move to the upside can come out of that. All right, if we take a look at the calendar and what came out on Friday, the biggest news came out again, it was all trade related, but from an economic standpoint, you had retail sales come out, not as big as expected, so down a little bit lower than what the market had estimated. This is kind of a big number. inflation or import and export prices have been dropping pretty sharply on a year-over-year level. Well, they seem to be bottoming out there. A nice little bounce higher in both those levels on a year-over-year basis. If we take a look at the economic surprise index here, right here you can see we're still slightly negative and pulling down because of that retail sales number, and we're still slightly negative on a G10 basis as well. Obviously not nearly as negative as we have been, so a relatively positive sign from that perspective. The GDP was also estimated with that business inventory report, and you can see it's still up around 2%. The estimates were down below 0.5%. So as long as economic growth expectations continue to rise, that's going to have an impact on inflation expectations, treasury yields, and a risk appetite for that matter. So, a very good sign to see the economic growth expectations kind of bottoming out and moving higher. And when you look at these numbers, it wasn't necessarily a big bottoming out either. I mean, if you look at Q4 2000, really it was right here in 2018, August is when things started to roll over. So this is the numbers that we've gotten since then. So, I mean, we were 3+ growth rates going into that, coming out of the 2016 low point, global slowdown in early 16-15. So we had some really good growth numbers coming out of that, and then we slowed down, and we're still in that 2% range, but you notice we're not going any lower. And you see that that our consumer, initially the consumer element of this dropped down, but see they've bounced back in a big way for 2 consecutive quarters, and we'd expect that to continue to be the case. You can also expect too the imports. You can see it starting to grow again, because import growth is a negative number for GDP, and you see export growth is starting to after a couple really light quarters. So we'd expect those numbers to start to improve from a trade. It's a very small number for trade. As you can see, the biggest number is consumer growth, and then you have government spending and inventory. So trade's a really, really small component, but it has an impact on overall growth. So we'll kind of keep our eyes on that as the Q4 number comes out. But the estimates are looking pretty good, much better than what they were looking in the middle of November of last month. If you look at sector trends, you can see for the most part you have strong trends here too. There's the S&P in the top left, but for the rest of them you have dark green shading, green lines. The only ones that you don't are utilities and real estate, and it's not surprising that they're weaker. There's interest rate sensitive, there's safe havens. They had really strong returns in anticipation of a recession that we never got, and so they're giving back. They're giving back those returns. Materials is also struggling a little bit with light pink shading, but barely bearish. It's pretty strongly bullish too, and even energy is starting to show dark green shading and a green line. So again, kind of another perspective of just how broad this rally is, absent the interest rate sensitive areas, which we wouldn't expect to participate too bullishly either. I mean, even look at consumer staples. It might have a smaller number here, but it's starting to show similar signs. Very strong bullish posture, rising, moving well above a rising moving average there. So for our trade idea of the day, I did want to take a look. There's this chart that popped out here. Let me show you this chart here. You can see that it's got the cumulative weight of the top 5 names in the S&P 500. Of course, that would be Facebook, Amazon, Apple, Microsoft, and Google. And they're really high weightings. In fact, over 69%. The only other time was 1999 during the tech bubble. A little different story now than we had then, because the markets we're not bubble driven, but there's no bubble going on here. So a little different type of market, but you can see what's driving it. And one of those stocks that's driving that we wanted to take a look at, or that we actually made the trade on Friday before the market closed, was Facebook. And you can see Facebook's been on a good bullish trend. It's had a little bit of a pullback here. It's got light pink shading and a yellow line. We got 3 red arrows on the 3 green arrow chart here. We got 3 red arrows on this, and we also got a dip below the blue line while still being above the Ichimoku cloud. So all of these are buy the dip type signals. If I take a look at where the Bollinger Band, where the volume support is for Facebook, you can see there's some support down in this area. So it's got room that it can go down. There's some volume support where we're at right now. There's more below this. Again, the idea of short-term weakness in the market and whether or not we're able to get going on Facebook, and knowing there's very strong support below where we're at, opens up the possibility of doing a short put vertical spread on this. So if we take a look at Facebook, trade we did in the Q&A session today, if we take a look at Facebook, we can sell that 190 strike, buy the 185, and you can see that's exactly what we did here. We sold the 190, there we go, sold the 190, bought the 185. It gives us a pretty decent probability of success, right around the 65% mark. I put that slice on the chart, and that's what this is telling us. So our support, we can maintain. If we were to continue to have any kind of weakness here towards 190, that would be okay. I'm willing to lose 381 bucks. We did 3 contracts, so a full position size. I'm willing to lose. I don't want to lose $1,000, so I'll lose 381. That's the most I'm willing to lose, and that number is down here below that 190, where that very strong support is. So if we break, we'll take that loss. If we hold, as you expect it would, because you always expect support and resistance to hold until it doesn't, then we get a high probability, pretty decent reward for this trade. All right, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping up there. Open up any new thread. If you have any comments or reactions or questions about anything we discussed in today's video, what were you thinking as you were watching? What popped into your head? Let's keep this conversation going, and you can reply to other people's threads too in that same forum that I showed you. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video. Follow me on Twitter for more content in between videos from day to day, and join our community at marketscholars.com, as well as the Facebook group we created. Again, thanks everybody for watching. Have a great rest of your weekend, and we'll see you all on Monday.